So thank you so much to the PCAOB for inviting FINRA here to the forum. It's nice to be back in person. The last couple of years, myself and Anthony have done this virtually. So it's nice to be in a room with folks to see actual reaction to what's going on. So thank you very much. And just to reiterate, I think I've said this every year that we come, the annual audit for broker-dealers, when FINRA receives it, it's a very, very valuable piece of information that is used throughout the year, both by our group, the Office of Financial and Operational Risk Policy, as well as member supervision. So what you do as auditors is very valuable to what we do at FINRA, and the fact that we're able to come here and speak with you individually and to share kind of what we're seeing, a little feedback, give you some insight into what's going on from a financial and operational perspective is very much appreciated by us. And just to give you a little insight, I am from FINRA's OGC group. I work in a policy group. We're Financial and Operational Risk Policy. We work very closely with the folks that your firms, the broker-dealer firms, see on a daily basis. So we work with the risk monitoring and exam staff. So within FINRA, I'm in the OGC world, and then there's the member supervision world. Within the member supervision world, there's risk monitoring staff. There's a risk monitoring analyst, a risk monitoring director, and risk monitoring senior director that are assigned to every single broker-dealer firm. That's the initial point of contact for every issue, every question, every back and forth between the broker-dealer and FINRA. In addition to risk monitoring, there's the exam staff. So the exam staff go into firms either annually or every 2 years or every 3 years, depending on the risk assessment that's done by the risk monitoring staff. So the exam cadence depends on what the issues are and depends on what the risk level is. So there are certain times where FINRA exam staff will go into a firm and they may or may not look at the financial and operational items in a firm. They may go in and concentrate on sales practice. So it is quite possible when the auditors go into the firm will say, hey, FINRA was in and they didn't necessarily have an issue with my balance sheet or my income statement. So the question there is, how much did FINRA look at it? And that's associated with the risk that was assessed with it. So just so you know, when FINRA goes in to do an exam of the broker-dealer firms, they don't necessarily always do a very deep dive look at net capital or 3.3 or balance sheet or income statement. So I think that's always important to share that with you guys. And when I talk for the next couple of minutes here, when I say firm, I mean the broker-dealer firm. I know every time when FINRA and the PCAOB kind of get together, when the PCAOB staff talks about firm, they mean the audit firm. So I'm going to try to say the broker-dealer and the audit firm, but if I say the word firm, I mean the broker-dealer. So that's always like an English-to-English translation issue that we have. So I have a lot of material that I'm going to cover over the next couple of minutes. And what I will say is because it's a lot of material and we're not necessarily going to go into deep detail on every single item, I want to make sure I cover a variety of topics for everyone. These words I'm going to put it in my own words, so similar to the other disclaimers that you've heard earlier today, the words are my own words and they're not necessarily the exact views of FINRA or any other regulator. So I'm going to share with you my thoughts and on these individual topics. So we're going to start with some hot topics. The first thing I want to talk about is SAB 121. So we just heard from SEC Office of the Chief Accountant. One of the staff accounting bulletins, SAB 121, that was issued I forget when it was actually issued, but the SAB talks about the safekeeping of crypto assets. And because of the prevalence of the ability for the investing public to invest in crypto assets, OCA has recognized that there's a risk to investors and risk to firms. So as a result of these risks, OCA issued this staff accounting bulletin that said to the extent that a firm, not just broker-dealers, but any firm, is engaged in the safekeeping of crypto assets, the firm should be considering putting an obligation to return those crypto assets to the customer, as well as a corresponding asset on their balance sheet. Now, this, for broker-dealers, our first question was, hey, is SAB 121 applicable to broker-dealers? The AICPA expert panel engaged with SEC OCA, who made it very clear SAB 121 is applicable to broker-dealers. So broker-dealers need to consider if they need to put this asset and liability on their balance sheet. So this is a little different than broker-dealer accounting. When broker-dealers are actually responsible for the safeguarding of securities, that is an off-balance sheet item. So we had a divergence in practice, number one. And number two, broker-dealers, generally speaking, there's only one broker-dealer that is capable of safeguarding crypto, has been approved to do that. None of the other broker-dealers have been approved to do that. However, there are broker-dealers that offer a platform on which a customer may invest in securities, and also that platform may have an associated module or something where the customer could initiate an investment in a crypto asset. It could be custodied someplace else. There could be a separate crypto custodian, but because the broker-dealer is involved, the question arose, should that broker-dealer be reporting that liability and corresponding asset on their balance sheet? So with the fiscal year end of 2022, this was an arising question. There were a few audits that were delayed for 2022, but as we got into December 31st, 2023, it became very clear that when the auditors were going in to do the audits of these broker-dealers, they had to raise the question, are you involved in this practice such that you may need to gross up your balance sheet for the safeguarding of crypto assets? Even though the broker-dealer in and of itself is not responsible for that safeguarding, the broker-dealer may be perceived by the customer to be an agent of the crypto custodian such that it required the gross up on the balance sheet. So what we saw towards the end of 2023 was that there were several broker-dealers that sought a consultation with the OCA, and generally speaking, the OCA was able to gather information. For the most part, all of those broker-dealers were required to gross up their balance sheet. There were only a handful of broker-dealers that went for a consultation, but it was becoming something within the broker-dealer industry, which we were concerned there was a divergence in practice. Some firms were grossing up their balance sheets, some weren't. What were the criteria? So, and that's just the accounting aspect, right? So we say GAAP first, let's get your GAAP financials correct first, and then we talk about net capital. So we were at a point where we knew that there were certain broker-dealers that were grossing up their balance sheet for this asset and liability. Then when we look to net capital, that asset is, it's a non-allowable asset. We sought guidance from SEC DTM staff, made it clear that asset is not a liquid asset, so therefore it's a non-allowable asset. So now we had a situation such that, there were firms coming, they were having to report their net capital and set aside net capital for these assets and liabilities. So it was certainly something that was a concern to the industry. Now, what happened in February is that the AICPA expert panel had a meeting, and they met with SEC OCA. And on the AICPA expert panel's website, there are criteria on that website which to the extent a firm can satisfy the criteria, the firm need not put that asset and liability on their balance sheet. So I won't go too much into the criteria, but essentially the criteria is like, as long as the broker-dealer does not have possession of the cryptographic key, and the custodian is the agent to the customer, and the customer realizes that it's the custodian that is its agent, not the broker-dealer. And on the website, there's kind of like a hit list of criteria that would influence that decision. And thirdly, if a broker-dealer had a legal opinion that made it clear that the broker-dealer is not the agent and the agent is the custodian. So that is guidance that's out there in writing. If a broker-dealer satisfies those criteria, the broker-dealer need not gross up the balance sheet and also need not take a capital. Obviously, if it's not on the balance sheet, you would need to take a capital charge for it. So the criteria are not necessarily automatic. There are certain firms that need to do a little bit of work to meet the criteria, to feel comfortable that they need not put it on their balance sheet. So in response to the fact that there are firms that were taking capital charges associated with this, and some of them are material, and those firms were working in good faith to satisfy all these criteria, the commission has given relief such that if a firm can demonstrate that it's working to satisfy these criteria, it need not report the asset as non-allowable. So that's actually, I wanted to make sure we hit SAB 121. It certainly was a very hot topic earlier this year. There are firms that are working diligently. And I don't know that all of the broker-dealers and all of the auditors were aware of this issue. So it certainly is an issue that came up and impacted the audit. So that's our first item. Daily 3.3, I want to make sure. Oh, we'll hit the, why don't we start with the CPE code is 744. Okay. My next item I want to talk about is the daily 3.3. Back in July of 2023, the SEC proposed some amendments to the customer protection rule. And essentially, these amendments are going to mandate a daily 3.3 calc. Right now, the calc is required to do generally weekly. There are some criteria that would allow a firm to do the 3.3 calc monthly. Right now, there's approximately 150 broker-dealer firms that do a 3.3 calc. 11 of those firms currently do a daily 3.3, and based on estimates, there's approximately 60 firms that would be, we estimate, would need to do a daily 3.3. Now, which firms would need to do a daily 3.3? Those firms basically that have an average of 250 million in customer credits over a 6-month period in both the customer and the PAB calcs. So why is the SEC mandating a daily 3.3? Essentially, there's several reasons, but because of the speed with which activity happens today and the potential mismatch of funding needs by the firm with the customer based off the changes in the daily requirements, it is perceived as being more accurate and more risk appropriate to do a daily 3.3 calc. Essentially, this is a proposal that's out there. Not totally sure when it will be adopted. We know that there were comments that were sent into the SEC related to this, like, for example, is the 250 million threshold the right threshold? If you look at total credits, what about those firms that are DVP, RVP, where essentially they'll have a very small lockup? It's not a very, it's not necessarily a very risky type of business if you have DVP, RVP. So should those firms be exempt from the daily requirement? Right now in the 3.3 calc, there's a 3% cushion. Should that 3% stay 3%, or should it be changed to something smaller? There are certain questions that come up related to timing. For example, cash sweeps. What if a firm gets cash in related to sweep activity at the end of the day and it hasn't been swept out that night? Based on the timing, the firm is going to send that cash out the next morning and then have to lock it up the following day. So these are all comments that the SEC has received. The SEC is looking at them, I don't really have great insight on to what's going to happen in the final rule, but I know that those things are being considered by the SEC. There are costs associated with doing a daily 3-3. What if your average credits goes below the 250? You know, can you stop doing it that day? In the proposal, there was a time period to adjust where you would, before you would stop doing the daily 3-3. So the daily 3-3 is another item that is going to be meaningful for those firms that it applies to. Something else that I want to talk about is the SEC's electronic electronic filing proposal. So back in March of 2023, the SEC proposed to modernize submissions of certain reports via electronic filing. This rule proposal related not just to broker-dealers, it related to many different types of legal entities. But specific to broker-dealers, it will have a meaningful impact on many firms, including the smaller firms. So key amongst them is the annual audit. So currently, the annual audit is not required to be submitted to the SEC via EDGAR. It's required to be submitted to the SEC, but it could be sent manually or it could be sent via EDGAR. This rule proposal will require every single annual audit to be submitted to the SEC utilizing EDGAR. That's number one. Number two, it's also proposing that all of the annual audits must be submitted to EDGAR utilizing XML, machine formatted language. So that is a meaningful change. There are many firms that can do this or readily have the ability to do this, but not all the firms, particularly smaller firms, have expressed concern and gave feedback, comments to this rule proposal that could be a burden to the firms to take their annual audit and then send it somewhere or have a functionality to put it in, you know, the footnotes and all the audit all the audit schedules into machine readable language. So the SEC is considering those comments. Also associated with the annual audit and the focus report, signatures. Right now in 17A5, all the reports need to be signed. This rule proposal is clarifying that an electronic signature does satisfy the requirement to sign the report, the focus report and the annual audit. You know, the oath in the annual audit, the exemption, the compliance reports. Within the rule proposal, it does state that the electronic signature must be done via the requirements that the SEC has previously provided. So like if you look at the EDGAR requirements, there needs to be an actual signature and then a facsimile of the signature, and it must be dated. So there are requirements associated with the electronic signatures. Also in these rules is on the focus report, there's 3 lines for signatures. It clarifies that in a firm, only 2 of those signatures are mandated. In the very smallest of firms that only have 1 principal, 1 signature would satisfy that requirement. And additionally, just so folks know, there will be changes to the actual focus report. So in both the Part 2 and the 2A, there'll be a change to the income statement. They're going to incorporate a line for other commissions, including commodities commissions. Right now, the commissions in the income statement just has securities-related items. In the Part 2, we'll also include a change for the minimum net capital requirements. There will be 2 separate minimum net capital requirements, one for SEC and one for CFTC. So going forward, once the new focus report is implemented, firms will be reporting to the extent that the firm is duly registered with both the SEC and the CFTC. Those firms will need to report 2 different minimum net capital requirements and 2 different excess net capital requirements. So I wanted to highlight those changes because those will be meaningful for those firms that it impacts. And the other item I want to talk about for a hot topic. This year, at the end of last year, I should say, we issued notice to members 23-21, revenue recognition. Now, the purpose of our notice to the members was not to provide accounting guidance. The purpose of our notice was to highlight that FINRA examiners are looking at revenue recognition. You know, broker-dealer net capital starts with GAAP equity. So to the extent that a firm is not recognizing revenue in the right manner and at the right times, that does impact net capital and the timing of net capital. So in that notice, we highlight that what's important, the first thing that the examiners are going to go in and ask the firm is, show me your policies and procedures related to ASC 606. So we're not saying what your policies and procedures should be. We're saying that you should have policies and procedures, and you should be able to evidence to our examiners how and when you're recognizing revenue. What are the performance obligations? When have they been satisfied, right? And for each contract, they're being identified. So that's kind of step one, right? And then in the notice, we give a few examples that we have seen upon exam. For example, there are certain M&A firms when, you know, if they receive kind of a retainer up front, there are certain firms that would recognize that retainer. If it was non-refundable, they would recognize it when it was received. And you know, we would say, what is your basis under ASC 606 to do that? We weren't saying it was wrong, we're just saying, what is the basis? And the firm didn't necessarily have documentation behind, that corresponded to ASC 606 to support when it was recognizing the revenue. So because we had seen that several times on exam, we decided to publish the notice to members, just to share that with the industry, to let you guys know that that's what, when our examiners go in, that's what they're going to ask for and what they're looking for. That's the hot topics. So I wanted to go over, there are certain things going on in the industry that we've issued some regulatory notice that I want to bring to your attention. Primarily T+1. T+1 is May 28th, so that is next week. So there's several things on the FINRA website related to T+1. The first notice up here, 2404, we have updated, there's several rules within our rule set that look to, you know, settlement date and how many days a certain charge or certain actions need to be taken after settlement. So 24-04 details a lot of that. I'm going to skip down Reg Notice 2315. That also talks about Reg T and 3.3 extensions that relate to the T+1 settlement. So T+1 is next week, and we're certainly keeping an eye out on how the industry is going to be impacted by that. We know that there's been a lot of work behind the scenes on T+1. Another associated rule I want to skip down to is the covered agency. So Reg Notice 2314 and 2315 also talks about covered agencies. That, so amendments to the covered agency rule relate to margin that needs to be collected on certain covered agency transactions. Covered agency transactions are TBAs that settle in more than T+1. They're the specified pools that settle in more than T+1, and they're CMOs that settle in T+3 or greater. So just to give you an idea of what transactions the covered agency margin rule relate to. That's what they relate to. That rule has been in the works for many years. And actually, today is the day that it goes live. So that's another rule that's going to be very meaningful to those firms that have this activity. Now, also on the FINRA website, James Barry has done podcasts. He's done webinars. There's a lot of material on FINRA's website to the extent that you have firms that are impacted by this. So there's a lot of information on the websites for that. let's see, and other notices that came out, the information notice on November 1st, that's always a favorite. That is the notice that tells you when each report is due. So in that notice, it'll give you your annual report due dates, no matter when your fiscal year end is. So we do it for every single month. In case someone has a fiscal year end of May 31st, it'll say when the 60-day due date is, and to the extent that your firm is able to avail itself of the additional 30 days, we have that due date in there as well. And I think that's meaningful. Over the years, we've gotten questions, is it due, there might be a difference in how it was calculated. So this way, the firm does not have to calculate it themselves. We've done it for you. It's in the reg notice. And then, let's see, another reg notice that's actually we've been working a lot on is Reg Notice 2311. So this is unique for FINRA. So it's a liquidity. It's regarding liquidity. So obviously, everyone knows the importance of liquidity. There's been talk for many years that we should put in a liquidity rule. So before you could put in a liquidity rule, you have to do a rule proposal. So what happened with this is we issued this Reg Notice 2311 is a concept proposal. So it's like actually before even the rule proposal. So it's a notice that went out. It has a lot of detailed information with respect to the thought process of what we would think should be in a rule or maybe another way to collect this information, if not necessarily a rule. So we are certainly seeking feedback from the industry. And certain things that obviously are spoken about within that notice is things like liquidity stress testing. Should that be a component? What is contingency funding? What is a firm's contingency funding plans, right? What is a firm's ongoing funding requirements, and how are they meeting their ongoing funding requirements? So those are like kind of the high-level concepts that were inside that liquidity concept proposal. And this, it's not anticipated that whatever the future rule is, currently, we're not necessarily anticipating that every single broker-dealer will be subject to this rule or subject to this reporting. At the moment, we're anticipating that the firms that are required to submit the SLS, which is a supplementary liquidity schedule, those are the firms that we anticipate would be subject to the rule, because those are the firms that have exposure to the industry, have exposure to customer funds and returning customer funds. And the firms that are required to do the SLS are essentially like carrying firms, firms that have 25 million or more in customer credits. So that's kind of a small number to ensure that the firms are able to satisfy their obligation to customers. And if they have repos, stock loan, or bank loans of $1 billion. So obviously, we're not looking to hit every single firm with respect to a liquidity proposal, but we want to get the firms that could have an impact on the industry and could impact customers. Okay. So those are recent reg notices that have gone out that are very meaningful. Next, CPE code 519. Okay. Exemption reporting. So we, especially for the auditor community, we wanted to make sure that we spend a little time talking about exemption reporting. I think the vast majority of our firms do send in exemption reports. Every year we definitely get many questions relating to the exemption reports. The first three bullets are 3 FAQs that are out there, published guidance. And this is still the published guidance that we follow. So to the extent that you have any questions regarding what report should I be doing, what should be in the report, those FAQs are still out there. The questions that I think in the last 2 years, when we've hit this slide at the PCAOB forum, I know Anthony has gone into a lot of detail explaining what each of the exemptive provisions are. We're not going to do that this year. What we're going to do is kind of highlight the main questions and some of the discussions that we've had around the exemption reporting. So, and some of the deficiencies maybe we've seen in the exemption reporting. So, to the extent that firms are claiming K2 single I, you may be aware over the last couple of years, FINRA has done a lot of work to ensure that if a firm is claiming K2 single I, they really are operating pursuant to K2 single I. K2 single I in the 3.3 rule, so it's 15C 3.3, paragraph K, subparagraph 2, single I. This says that a firm does not necessarily need to do a 3.3E calculation if they have a separate account, a K2I account, for which they receive in cash and promptly forward, receiving cash or securities and promptly forward them. Okay, so many years ago, K2 single I was used as a default exemption, kind of a way for firms to flag to when they submitted the focus, hey, I'm not doing a 3.3 calc. So because it was a default exemption, a default way to highlight that you weren't doing a 3.3 calc, the firms claiming that became a mixture, right? They weren't really, and what happened was when firms had to report via their exemption reporting, the firm and the auditor would say, my firm is a K2 single I firm. But when you looked at the firm's business model, they weren't actually ever receiving funds or securities. They didn't actually have a K2I account. They didn't have that operating model. So what we've done collectively over the last couple of years is we're trying to get the exemption reporting true to what's required in the rule, right? So to that fact, we've had our risk monitoring folks go out to firms who are reporting a K2I exemption, and maybe their minimum net capital requirement is $5,000. Well, you can't be a $5,000 firm if you're a true K2I firm, where you're receiving cash and sending out cash, right? So that is something that I would ask as auditors that you question as well, because our exam team is going to continue. There was, I'm going to say 2 years ago, there was about 1,100 of these firms that were claiming K2I and had less than 100,000 minimum net capital. That number is down tremendously. I think it's probably less than 200 firms now. But those firms, we are still going to be following up to understand, are they true K2I firms, and they should have a 100,000 minimum net capital requirement, or are they not? Now, several of those firms may fall under what we call this footnote 74, which is explained in the FAQ. They neither have direct or indirect obligations to customers. They neither hold cash or securities. And in that case, it would be appropriate on their exemption report to report that they were footnote 74. So that would be appropriate. And we have definitely heard from firms and auditors, well, listen, I'm sending in an exemption report, and I'm making sure that my exemption report ties to my membership agreement. Hey, FINRA, in your membership agreement, it has K2I. So one of those FAQs talks about if a firm and their auditor believes that they're in this situation, they can certainly go back to their risk monitoring analyst, who many times will come back to my group. We'll have these discussions, and sometimes the firm's operating model isn't always particularly straightforward. It may not be straightforward that it either is or isn't K2I or K2II or 74. So we've had many discussions with firms where it gets a little bit complicated, to be honest. And so we'll work with the firm to help them understand what the correct exemptive or lack of exemptive provision that they should be reporting, and then if that needs to be updated in their membership agreement, that will happen as well. And if you just need to update your exemptive provision in your membership agreement, you don't need to go through a whole CMA or MAP process. So we wanted to make sure, the goal is to get the exemption and the compliance reporting accurate based on the rule, based on the SEC's rule. So that's K2I. Multiple business activities. So to the extent, and we've seen this on a very limited basis, to the extent a firm has both an introducing business, for a certain line of business they might be introducing, but for another line of business they might be carrying. For those firms, you would not check off like K2II and do a 3-3 calc. To the extent that you're doing a 3-3 calc and you're carrying and responsible for customer funds or securities, then you would not check any exemptions. So we see that from time to time. I just wanted to clarify that. And the K1 exemptive provision. So K1 is intended for firms that are exempt from SIPC membership. That is the intention of K1. K1 is for firms that limit their activity to mutual funds and variable annuities. There are certain firms that do mutual funds, variable annuities, and 529s, because they're all kind of similar. However, a 529 is a municipal security. So if you're a firm that does all three of those, you cannot claim K1, because doing a 529 is doing a muni security. So therefore, you cannot claim K1, and you need to be a SIPC member. Okay? And those firms, based on their business model, so to the extent that those firms are direct to the mutual fund or direct to the insurance company or direct to the 529 plan, those firms may very well fall under footnote 74 if the firm never receives in cash or funds and the cash never goes through the broker-dealer. So this is where it gets like a little bit confusing. Like the whole exemption reporting is not something that is a second language to anyone. It's something that's kind of visited by the auditors once a year in the firm. So again, this is where we're trying to stay true to what the actual exemption report and 17A5 says that we should be doing. I'm going to stop there. Exemption reporting. Risk monitoring and exam observations. So I'm kind of watching the clock too a little bit. Every year, FINRA issues an annual oversight report. This is a very interesting report, and I encourage the auditors as well as the broker-dealer firms to look at it. These are areas, and within the report, it's kind of a lengthy report. Within the report, there's a financial and operational section, so I'm going to concentrate on that. But this is a report that kind of highlights to the firm and to the auditors what FINRA is kind of looking at on exams where we're finding multiple exceptions, right? And this could also be an area for which the auditors should look at because it could have an impact on net capital or 3.3 or something that, you know, if you got oversighted by the PCAOB, they may be looking at as well. So I encourage you to look at this report. Some things I want to highlight from the report: revenue recognition. The whole thing that the notice to members was about, that's in this report. Firms need to be able to evidence their compliance with ASC 606. Very important. Another topic that's probably in the report every year is expense sharing and management services. This is an area upon exam that examiners look at frequently, and we frequently find deficiencies. And now what I would say is, expense sharing and management services I see as two different things. Expense sharing is when you have a broker-dealer and you have an affiliate. It could be the parent, could be another affiliate, and then you have a third-party vendor. And so the broker-dealer and the affiliate are sharing the services of the vendor. Maybe it's Bloomberg terminals, maybe it's leases, maybe it's something like that. FINRA Notice to Members 0363 was issued in 2003 and is still our guide to expense sharing and what firms should be doing. And essentially the purpose of that is that a broker-dealer should be reflecting their financial position accurately. So to the extent that there is an expense incurred by a broker-dealer, it should be considered for net capital. And again, we say GAAP first and then net capital. right? So GAAP first, to the extent that the broker-dealer is the obligor on some sort of agreement, like a lease agreement with the landlord, right? The broker-dealer is a primary obligor on that lease. Well, what if the lease is in the name of the parent and the broker-dealer is using half of the floor? Well, that is an expense associated with the broker-dealer, and it should be recognized for at least net capital purposes if it's not recognized for GAAP. We've had many conversations, and there's additional SABs that relate to subsidiary reporting and what expenses should be reported on the subsidiary. But to the extent, we always say GAAP first and then net capital. Within the net capital rule, there is a rule that says if an affiliate has agreed to take on an expense of the broker-dealer, that affiliate must have the financial wherewithal in order for the broker-dealer to avoid taking a net capital charge associated with that expense. So to the extent that the auditors, and this is a topic where I feel like I'm very much oversimplifying and trying to squeeze it in a short amount of time, but this, suffice it to say, from an audit perspective, if you're going into a firm and you know they are incurring expenses and they're not reflected on the income statement, then there's additional work to be done to understand if the broker-dealer is accurately reflecting their net capital as well as GAAP. Notice to members 0363. And certainly, we definitely get conversations in from, we get questions in from risk monitoring and exam on this topic frequently. So if you see something and you have questions, feel free to ask your firm to reach out to the risk monitoring person who will reach out to our group. I want to hit a few more things. Guarantees and contingencies. So the 3.1, SEA Rule 15C3.1, paragraph D, Appendix D, I'm sorry, paragraph C. It talks about guarantees. We've seen this come up recently. To the extent it's a prohibited act for a broker-dealer to guarantee an affiliate, like I'll say outside the normal course of business as a broker-dealer, unless the broker-dealer takes a net capital charge. So I'll give you a few different scenarios. The broker-dealer is listed as a guarantor on a loan that the parent took out with a bank, an unsecured loan. Or the broker-dealer is listed as a guarantor on the lease of an affiliate. Those are guarantees which are outside the normal course, and the SEC does not want the broker-dealer's capital to be at risk due to a contingency that exists outside of the broker-dealer's normal course of business. What has come up in the past is clearing firms. They kind of, act as a guarantor to the clearing firm based on activity. That's not what we're talking about in that paragraph. We're talking about guarantees outside the normal course. That's something that has come up recently. Contingencies. I think we mention this every year, whether it's related to an arbitration or a lawsuit or anything like that. Especially at year end, what we've seen is certain, is the accrual for contingencies, to the extent it's estimable and probable, is that on the balance sheet? And what we've seen a couple times, infrequently, so I don't want anyone to get the impression that this has happened, subsequent events, right? So to the extent that there's a subsequent event, there's a settlement of an arbitration, there's a settlement of a litigation. To the extent that that happens prior to the issuance of the auditor opinion, that's a subsequent event that now you have clarification of what that liability should be. So the liability should be updated on the firm's annual audit. Disclosures about contingencies. If there's a material contingency that's reasonably likely and material. Those, and we have rejected audits for lack of footnote disclosures because we view them as that important. So it's very important, the footnote disclosures. And talk about disclosures, the going concern. That's another one we look for. Very, very important to us, very important. I know that there are other regulators that look at the annual audit, for example, SIPC. they look for these going concerns, very important to us. Let me see. Those are all things that I believe are in the oversight report. And then just to give you a little bit more insight regarding like the annual audit, we know that most firms have a fiscal year end of 12/31, but not all firms. We are seeing certain firms moving their fiscal year ends outside of 12/31. We think potentially that might be related to the availability of auditors and potentially the ability to take the additional 30-day extension. So we know that several years ago, the SEC had granted that relief for certain smaller firms to have an additional 30 days. The goal of that was to get a good audit in. You know, that's how much we value the audit and the audit function, is we want the firms to make sure that they're getting, that the auditor has sufficient time to do all the audit procedures that they feel are required to send in the audit. And so I would say of all of our broker-dealer firms that are eligible for the additional 30 days, there's 90% of our broker-dealer firms are eligible to take that. And as of now, probably about 50% of those do take advantage of that. So we believe that's pretty meaningful. And it's hopefully, you know, something that helps the audit profession to have sufficient time to do what needs to be done to send in a high quality audit. And then as far as the exemption and compliance reports, just to give you a little insight, with respect to the compliance report, probably only about 5% of our firms do a compliance report. And with respect to exceptions or material weaknesses, there are firms that do report material weaknesses. A lot of those material weaknesses, they fall into kind of certain broad categories. Some of them are around the completeness of customer balances, and like the data quality related to customer balances, customer coding, those things, customer statements, the completeness and accuracy of customer statements, getting all the customer statements out. How do you know it's a complete run? The market values that are in the customer statements, things like that. And so, and then there's a few exceptions we see with possession and control, but not as many as the first two categories. So that's just to give a little insight. And as far as exemption reports, probably 95% of our firms send in the exemption reports. The reason why you would report an exception to an exemption is generally if a firm receives in cash or security and does not promptly transmit by noon of the next day. So we do see anywhere from a handful of those instances to like, there's certain firms report like buckets of them, which could be thousands, right? Like certain types of transactions didn't meet it by noon of the next day. To the extent that a firm is reporting many exceptions to their exemption, it does not automatically mean that you become a carrying firm. It's just something to highlight to FINRA that with respect to customer funds and securities, there's that delay going on. So with those, perhaps risk monitoring exam will go into the firm and say, what are the controls around this? What's happening? Why is there such a delay? And to understand what's going on. So the exemption reporting is definitely something that's utilized by our staff, as far as exams and understanding what's going on at the firm, because that is customer funds. I think I've just about hit the end of the time now. Does anyone have any questions? Yes.
I was just curious what your take is on FINRA's ability to handle the influx of potential new broker-dealers, given the new SEC dealer definition.
Yes, great question.
Exams and membership to get through to that due date of, was it next 25?
That's a totally great question. So there are working groups within FINRA who are working on all of that stuff, right? Saying what's the estimated number of firms that this is going to impact? What reports are they going to be doing? The focus report, or maybe they're going to be doing a FOGS report. How are they going to send it in? Where is that data going to be stored? Who's going to be the risk monitoring? So all of that is there's a project group looking at it from multiple different aspects. Great question. Fabulous. I'm just over by 3 seconds.